I mean, it's very hard to borrow money on mobile land packages, and that's what I've been doing. So, or if you do borrow, it's really expensive.
I was just looking at a mobile home for some client that I have that wants to sell their house and buy a mobile home. And there was lender contacts on there, saying this guy was the master at mobile home financing on the listing. I could probably dig it out and find that for you, or you need like hard money type stuff, probably.
Yeah, like hard money stuff, because
Gotcha.
I'm doing mostly I'm doing the developments, and you got to order the manufactured homes. God, I think my dealer told me they're 16 months out now for certain models. But I've been waiting for over a year for a well to be installed on 5 acres. Actually, that was property Dave talked me into buying, and if we ever get it done, it'll be a great deal. I'm glad he talked me into it. But
crazy stuff. Yeah, life is everything's out of sync, a little out of whack right now. A little out of whack, but
yeah. How's the market? Is it still appreciating? Because I'm kind of getting the feeling that it's appreciating, but at a much lower rate now.
Well, what I think's going on is that, and I'm just, facing the crowd here, but I think that the big, huge sales, the crazy high price sales have now all recorded from the first quarter, and the sellers all saw that. And so now they have this in their mind. They're greedy and they are setting the prices too high. And because buyers are trained to think they have to pay over the list price, and the sellers are being greedy and wanting to set it at the tippy top price and saying, my neighbor sold for this, my property's better, the old my property's better. And they don't take the advice of the agent necessarily right now because they're greedy and they're setting it too high and they're sitting. And I think there's going to be, I don't think prices are going to like drop necessarily, but I think that I think there's going to be a lot of price drops on the MLS because people are listing it too higher. And then, that'll scare people. And there's going to be this, I feel like there's going to be a disconnect over the summer between what sellers think they can get and what buyers want to pay or can pay. And things might sit a little longer because of the perception they have to pay way over list. And so they're miscommunicating with each other on paper, you know what I mean, out the gate. And that'll kind of rock the bus here for a minute.
Yeah, no, I totally agree. I was one of those sellers. We figured we were doing it was a small single family on 5 acres, and we thought in Thurston County, and we thought, oh, it's probably worth $525. Let's put it at $535. 3 weeks, like nothing. We dropped it to $525, and then we had 3 people that were seriously interested, and we accepted a FHA loan. And when we found out how low the limits are in Thurston County, it's like 350,000 under Pierce County. So we were a little shocked.
Yeah. So valid. Yeah, I think at the price points 6, 5, those types of things or lower, those are the people getting hammered with the interest rate issues. And one of my agents got an offer on a property in Everett a couple days ago, like over the list price. And I'm, he's a newer agent, so I'm helping him out. And I'm like, dude, this person, their pre-qualification letters from like the end of February, and they're saying they're putting 20% down. The contract says 10% down. You better, everybody was excited about this offer. I said, something's up. If they thought they were going to qualify here in February, they're not qualified anymore. And that's exactly what happened. They had to withdraw their offer because the agent was a stupid ass and ding dong. and they weren't qualified at today's rates. Right. So,
yeah.
And then the other offer they got was from Home Partners, that has a bunch of contingencies in there and all kinds of stuff. So I know those work sometimes, but you know, after only being on the market a week, they can probably just wait a minute and see what's up. But yep. Yep. I basically canceled a $2 million listing this last week, because the seller was demanding it was a referral to me, helping somebody with kind of a, you know, something that had a little bit different situation than a normal house. So they called me for help. So I couldn't blow it for them. Right. So the seller was one of those sellers. And I'm not just talking because it's just happened to me. I just talked to somebody else that their property's sitting and they did exactly what I just described. And I literally canceled a $2 million listing because the seller was unreasonable. Property's beautiful, but they want $200,000 more than the property's worth in a neighborhood that isn't used to paying that much. And I don't, you know, I can only tell the truth, right?
Right.
And I don't like making myself look bad, putting something stupid on the market, but I did it because the market is stupid and you don't know, but told them from the beginning, it's 1.8. And they're like, nope. I said, would you like me to show you how we arrive at the numbers? You can be involved in the pricing. Nope. Don't need to see it. My property's worth 2 million. Everybody says so. I'm like, who's everybody? You know what I mean? Your neighbor. I mean, so I kind of, after 10 days of having zero traffic, not even brokers, I basically said, I'm going to be the bad cop here and I want out of this thing. And, you know, sorry to my friend who brought it to me. And so that's what I did. Kind of crazy. Right. And then the next day I sold a $320,000 condo to one of my clients' dads, 68 years old, first home he's ever owned in his life. And, you know, he thanked me up, blessed my family up and down and sideways. I'm feeling blessed right now. Boy, I'd rather do that than deal with these sellers that are crazy, you know, kind of not thankful jerks, you know, requiring us to be there from 10 a.m. to 4 p.m. every day it's like, get away from me. You know what I mean? I don't like doing that type of business, you know, but, that's my story. But,
I don't, Dave and I were talking about that. I'm saying, geez, you guys have to put up with so much more stuff, you know, as realtors with clients. So,
well, like I said, one of my agents just did a flip and has it on the market. And again, it's he believes and he knows what he's doing, that it's priced 25 or more below where it should end up, and it's just sitting there, you know. And I said, well,
wow.
I think it's because at that price point is where the buyers are getting hammered, you know, with the interest rates. I think the people that are in the $1 million range and all that other stuff, those people weren't looking at their maximums because they knew they had to pay a couple $100,000 over the list price. So now maybe they're, with interest rates up, you know, they're still able to afford the right price. It just won't get bid up. Right. So there's all these factors in play right now. And there's definitely going to be some disconnection, I think, coming down the pipe here on, you know, buyer sentiment, willingness, abilities versus sellers still, because it still is a seller's market at the moment. So just have to have the right brokers involved to be able to educate people in real time with what the situation is. And if people don't want to listen, you know, it's hard. Brokers don't want to give up the business, but you know, like I said, I just canceled the $2 million listing because it was more stressful to me to deal with somebody that's unreasonable than lose a $50,000 commission. So there you go. So not that we're talking about all that.
Nice to be in your shoes.
Oh, I don't know, whatever, right? You can make that on investment property, well, probably with less stress, but, I don't know if I hook, line and sinker you guys in this morning on my post about, this commercial multifamily loan. Does anybody want to hear about that? Or does anybody have anything they need help with before I tell you what that is? Anybody?
I'm good.
That's great. I have a question about the multifamily. Can I ask now, or we can
Yeah,
just?
go for it.
Yeah. Okay. First, my name is Hamed, and thanks for the great discussions here. I'm just learning a lot, and my hope is to learn more here. So I'm pretty new for the investment in real estate. And at first, I wanted to just buy my first single family house, and then I switched to looking for multifamily. And now I'm qualified for 5% FHA loan for a duplex. And I don't know if that's a good option for me to start or no, if you guys have any tips or idea for this.
I think it's
And
good.
yeah,
Let Albert's here. We'll let Albert weigh in on this too.
yeah. And if I have any other, I wanted to know if I have any other option for the as a first time buyer other than FHA loan with 5%, because I'm going to have house hacking.
I'll let Albert
Yeah.
step in.
Sure. Okay.
Hey guys, how's it going?
Good. Thank
So,
you.
Yeah, I think FHA is great. There's some hurdles, of course. You know, there's a self-sufficiency rule that you're going to have to meet.
Yeah.
And it's very tough because in the West Coast markets, to get the rents to be the same or greater than your monthly payment, that's what the rule is about.
Right.
It's very tough because your rent to your price is fairly low.
Yeah.
You could always get private money, get into the property with 10% down, create your equity, and then take FHA to get out. That's one way to do it when your rents are way higher. But
okay.
with the way that King County fourplexes are, I mean, even in Georgetown, it would be tough at a I don't know, what, $1 million for a fourplex.
Yeah.
You know, so I mean, in Kirkland, the last one I saw in Kirkland was like 2 million. So no way that's working.
Right.
So the general rule is you're going to need about per month, the rent's going to have to be roughly 0.75%. So if it's $1 million, your rent has to be $7,500 as an example. And that's market. It doesn't have to currently be at 7,500. The appraiser just has to value it at 7,500 gross rents. So,
yeah. Okay. I'm only qualified for a duplex, and yeah.
But you might be more if you have the other tenants. So hopefully they're factoring in, you know, the other tenants' rent.
Yeah,
right?
the lender I'm working just saying you are qualified for only duplex, and they're counting the rent for one of the offers I showed them.
Yeah.
And so you say that's like the only option I have right now to go with, like.
You might want to have somebody else check your income just to make sure they're using the rents or not, or if they're using only your salary.
No, they're using my rent. The rent to additional.
For the other unit.
Yeah.
But they're only assuming one unit, right? They're not assuming like
just one unit.
Yeah. You might want to run the scenario with the triplex and fourplex to see what the 4 units would have added up to.
Oh, okay.
And see if it's feasible, because it might qualify you, but not enough for the size of a property that you want to buy in the area that you want to buy in. Because maybe you could buy $1 million fourplex, but there are no $1 million fourplexes in, I don't know, Ballard, for instance, because they're all 1.4 or 1.5. So then you have to decide, do I want more units, or do I just buy a duplex in a really nice area? Maybe not a fourplex there, because I don't want to live in Tacoma, for instance, or whatever. That's million. So yeah.
All right. Yeah. Thank
Julie,
you so much.
You're welcome. Yeah. And Julie, there was a 5% down conventional program, but it's only for low income. And the program deems low income as 82,000 roughly. So it pretty much doesn't allow people to buy properties anywhere, because if you have 82,000, it's kind of hard to qualify for a fourplex or a large property like that.
Yeah.
So
Got it. Yeah.
But you could, if you're in Oklahoma City, where it's 320,000 or something for a fourplex.
Right. Yeah. Yeah.
So.
Good
Okay.
stuff.
Yeah. Thank you.
Anybody else have questions? We got the master, Albert, on here today. He's always so helpful. We appreciate you very much, Albert. How about you, Holly? Got any financing questions on any of your deals you're working on?
No, I'm just looking at doing a bank statement loan. I guess there's a DS, instead of doing a DSCR, I can get a better rate doing a bank statement loan for a 40-year, 10-year interest only loan, which will really help the cash flow. So that's what I'm looking at now. And then I'm also exploring other options for like a multi-use loan. So like, let's say you're going to buy a property, use it as a B&B, like a bed and breakfast, and there's an extra like an ADU or mother-in-law unit on the property. And you're going to stay there from time to time. So maybe use it as like a second home. And then being able to develop the rest of the property into maybe like agriculture or maybe some type of camping situation or something like that. So I'm looking at loan options for that. Someone mentioned a multi-use loan option. I'm not sure what that entails, but if Albert has any information on that, that'd be helpful.
Are you saying about the multi-use? Do you mean like
yeah,
commercial use?
I guess, is that just a commercial loan? I'm more just experienced in, the residential or multifamily 2 to 4 unit loans.
What's the loan? What's the loan size?
Yeah.
Oh gosh, it'd probably be ideally 1 to 1.4.
Mm-hmm. The struggle you're going to have is that banks aren't going to be very used to that business model, whether you're doing, I don't know, halfway houses or rehab clinics or adult, elder care facilities or whatnot. I think there are some credit unions and community banks that would, if you had a relationship with them. But right off the bat, they usually hesitate and they and ah, and then they go to their credit committees and then they decline your loan. But if you were working with them and you had 3 of them, let's say they were all privately financed, or you bought it with conventional and then converted it, because you can buy them with conventional, right, and convert them. And then they saw the model, and then you needed money for a subsequent acquisition, they would probably lend to you. But that you already have 3 successful stories at that point, right? So that's what I would say about it. I don't know exactly, because I don't deal with you're talking about commercial use, right? Like non-residential use.
Well, it'd be residential plus like other business purposes. So it might be involved, more involved, like presenting a business plan or something like that to get financing, I would assume.
Yeah, that's more of a small business. That would be like a sound banking company, like in Lakewood, or like a very small community bank, not like a larger one. I'd go to a tri-coastal community or one of those. And have you already done successfully one of these, or is this like a new venture?
This is a new venture. I'm just exploring options right now.
Then probably hard money, private money, or get bankable, use conventional, get in, then convert it. Because when you're not buying the structure as the business use yet, it's deemed to be residential use, right? Single family house. You can buy it with conventional and then convert it and keep your conventional loan. But after you have, let's say it's a senior facility, after you have all your ADA ramps, or you have all your senior upgrades in the facility, you're not going to be able to get conventional anymore, because an appraiser is going to come in. They're going to see it all. They're going to see all your stations, your beds. They're going to see the nurses, the contractors that come in and help the seniors. At that point, there's no way you're getting conventional anymore, but you could get it on the way in. So does that make sense?
Yeah, I'm looking at that as an option. It might have to be, I have a question. So like with the, and I have to jump off here right before noon, but so like if you are a remote worker, like you don't really have like your primary changes or your in between things. One, like, can you get a FHA or conventional home buyer loan, basically for a state that you're mostly in, or how does that work? And then the second question would be, can you get a second home loan in another state, a vacation home, if you don't have a primary home?
I would say yes and yes, but for the first question, it depends if you're getting W-2 or 1099. Like, are you self-employed? Are you W-2 and working through an agency, or are you actually a full-time W-2?
Self-employed, real estate broker.
Well, then it's just whatever the self-employed rules are, 1 year to 2 year tax, and you got to have been doing it for 2 full years. But you might only need 1 year tax. So we'll look to your last tax return or your 2021 taxes for a full doc loan. Now, if you go to that bank statement loan you talked about,
would they have a problem with like purchasing in another state with a 3.5% or 5% down?
Well, that would be full doc. So then you'd if you're saying 3.5, FHA will require 2 years of tax. So they're going to average your 21 and your 20. And whatever that number is divided by 24 months, right? For monthly average is your income that they're going to use.
Okay.
But you'll need a very good case of why you're going to move to Jackson Hole or wherever you're going, right? Like that makes sense. Because if you're living in Seattle and then you're going to say, hey, I'm going to buy in mid Oklahoma, the town has 10,000 people, they're going to be very curious why you're moving there as a primary.
It would be in the San Francisco Bay Area. I have family there, so.
Oh, so yeah. So your letter of explanation for motivation would say, I have family and we want to raise our kids there because this is a great school district over in, I don't know, Costa County or whatever, Santa Clara. And then you would move there. So that would be a great reason. That would fly.
Okay, good to know. And you can use a second home loan without using.
You could, but I don't know why you would. You probably just do primary, unless you don't plan to move there as a primary.
Yeah, I guess the question would be, if I used it as a primary, do I need to file taxes? So that would be the other question.
Well, taxes depends on the loan program, right? It's not whether you live there as a primary that it requires taxes. Because there are bank statement loans that do primary that don't require taxes. But you're going to pay 2% higher in rates just to get those loans.
I think she means income taxes, if she's then required to pay California income taxes or something.
Oh, that's a state question. I think it's only if you're a primary resident there.
Yeah, so I'm just looking at like, if I use my primary home in California,
I see what you're saying.
I have to pay more tax.
Well, this is only on the loan side. What you claim to California and the feds, I don't know. So yeah, that's
I know. I guess, is that an ethical line though?
Yeah, it's definitely a gray area.
It probably matters, Holly, where the income came from. So if it was earned in California, you're going to pay California tax. If it's earned in
No, but California is like the US. They're pretty crazy. So if you're a resident of California, because I used to be a resident, they tax your worldwide income. You pay your 9.3 or 10 or 13 if you're really a baller on everything, even if they're not made in California. So what they do is they give you credit. Like if it's 3% tax in Arizona, they give you a credit for that 3.3, but you still got to pay the other 6 to California. Does that make sense? Like if you're in New York and New York is 9 or 10, then you might not pay anything to California because New York was higher than California. At least that's what my CPA told me when I used to live in air quotes California. So do
you get a credit of state income tax payment against federal?
They were saying something about that. I don't know if they passed that. That's a new thing though. You're talking about the property tax and itemized deductions, right?
No, I'm talking about your income tax bill. If you have a state income tax.
No, you got to pay it in addition. That's why it's huge because it's 9 to 13%.
Who would live in California? Dante, why are you living in California?
Newport Beach is pretty nice though.
Yep.
California is awesome.
Yeah,
The weather, you can't beat the weather, really.
yeah, it's the only thing you can't beat. But yeah, the taxes are brutal. So
Totally.
I don't know if any of you guys claim a real estate professional, but California doesn't recognize real estate professional either. So you could be 0 on your federal, but you could be positive 500 grand on your California tax return and still pay tax. That's just something I found out like the last year when I did a cost seg or a bonus depreciation.
Yeah.
So, you know, that's a big deal if you live in California. Yeah.
Well, good stuff.
What
else you
question?
guys-
That question like involved like 3 different industries, huh? Tax, income tax, state income tax, and lending guidelines.
Yeah,
Nice.
there's a lot to think about when you're planning your next venture. So thank you. I gotta jump
You're
off,
welcome.
guys, so I'll see you next week.
See ya.
See ya.
All right. What else you guys got? Brenda, did I see you bought a construction company or something? Was that you? Can you guys hear me? Hello, hello.
We can hear you.
Oh, maybe Brenda, can you hear me? Going once, going twice.
Yeah. Can you hear me now?
Yeah.
Oh, okay. I think I had my mic settings down. No, my husband, he owns a construction company, but it's been a couple years. There's nothing new.
Oh, I thought I saw somebody post somewhere this last week about we just bought a construction company, and I don't know why I thought it was you.
Oh, no, not me.
Okay. Well, what else is going on, guys? I have some plumbers showing up, so they might knock on my door here any minute. But anybody else have anything?
Didn't you
they
have
need
some
help with?
news, Julia, about some great commercial
Yeah.
program?
Yeah. So actually, in Albert, I talked to this guy again right before we came on here, and I said, "Is that really the rate?" You know what I mean? So, and he said, "Oh, it'd be more like 4 today, but still, that's good, right?"
Yeah.
So I'm working on a 5-unit offer, not for myself, but for a buyer. And it's in Seattle. It's expensive. I wouldn't buy it. And shop in loans, and the listing agent provided this lending information, and I'm like, what's this? So there is a commercial lender out of Tacoma. Albert, you don't do commercial loans, right?
No, I don't.
Right. So we're talking about 5+ units or other commercial type properties, guys. If you need anything below that, Albert clearly is your dude that you want to talk to, Mr. Best guy ever. So, but for 5 units and above, there's a group out of Tacoma called Crux, CRUX Commercial Real Estate. Has anybody heard of them before? No? You guys not say yes or no? No? No.
Now I have, because you
Now
told
you
me.
have,
to.
yeah. So this lender so the issue with buying any type of apartment buildings or stuff in Seattle, as Albert was explaining earlier, is that the rents are low in relation to the purchase price, right? So literally at a value add type of building, even if it's just, the building's okay and you're going to raise rents by 20% because it's old school mom and pop and la-di-da, you're going to have to put 50% down if you can't get seller financing or something like that. Even if you were to get seller financing, it doesn't, you're going to be in the hole on the cash flow on something like that if you were able to borrow more than the 50% down on the current actual numbers. So lots of investors are looking for bridge loan type products, right? Where they get a loan based on, the higher rents or the value add plan or whatever. More expensive, usually a lot more expensive, right, Albert? For something like that. But these guys at Crux Commercial Real Estate floated out this loan product that was, let's say 50% down would be 830,000 or so for this building. So they were offering $1 million based on they said effective gross income. Based on, I asked them, what rents are you using? They said, we're using effective rents on market rents. I said, are you using some sort of loan to value, low threshold on some, future value ARV? Or they said, no, we're using effective rents on market rents, if that makes sense. Do you guys following what I'm saying? And 35 to 40% on expenses, and it's not a debt service coverage calculation, they said. I said, okay. So they're offering $1 million normally, which would be 830, 50% down. Now you can get it for $1 million, which would be obviously a lot less down. And I was told the rate was 3.625 on the first 5 years. So it's a 10-year term. First 5 years fixed at 3.625, where it readjusts and reprices starting in year 6 at, the federal home loan rate, 5-year rate, plus a spread of 1.75 to 2.5, depending on your borrower strength. And then the second, so it's a 10-year term. Prepayment 54321 in the first 5 years, no prepayment in the second half there, no prepayment if you sell in the first 5 years. Those are stellar loan terms. I asked him, really?
Yeah.
Is it really 3.6525 today? He said, well, it'd probably be 4% today with rates bouncing around, but still good terms, right? Have to be qualified, solid borrower, with a little some experience to get something like that. And of course, proof of the down payment proceeds. But Albert and I were saying, I don't believe it till I see it. But it's through Crux Commercial Real Estate in Tacoma. But they're loan brokers. Like Albert is a loan broker. So they shop all the loans. They do big CMBS type loans and all that stuff there as well.
You don't see it, Julia, till you get the loan commitment. But by then you've signed all their borrower authorizations and their fees and everything.
Yeah. But I mean, still sounds like somebody you want to know about. Mm-hmm. And that's that for this particular 5-unit in Seattle, which would apply to a, 7-unit, whatever you're looking at. That's a good sounding deal, right? That's like the cheapest deal in town, that I have heard about.
Because even Luther, that was supposed to be pretty good. What did they tell you? 4.5?
So Luther Burbank Savings was at 4.55%, but they don't have a bridge loan product. So it was still the 50%-ish down. The rate, so it wasn't, we're looking for a lower down payment situation. And they had prepayment as well. So that's the loan. If anybody's looking for a commercial loan, I would call those guys, right? I think they know what they're doing. And we'll see if anybody, so now I'm going through it, Albert, where we're trying to get this loan done she had to add her sister onto the loan because she only had X amount of the down payment and the sister was providing the rest. So now sister has to be on the loan, which she says, fine. So we'll see what happens. Are you guys, anybody else looking at commercial loans? Anybody interested in doing larger multifamily deals? If that's the case, then call me. But it's a vetting, it's all based on your borrower profile, right?
I have a question for Albert.
Go for it.
I guess for everyone, really. I can kind of explain my scenario and what you guys would do next. So I do the rent by the room big houses, co-living in SoCal. I bought a house in 2020, appreciated a lot. There's like $300K in equity there. and then I'm in the process of the second one. I used some money and some credit cards to finance, like 0% credit cards to finance some of the repairs for the second house. And now my credit score went down. So that's one thing. I'm trying to pull up money out of the first one or the other way. I'm trying to evaluate whether I should just do a refinance cash out. That I would only get 100-ish, 150-ish out. The plan is to kind of grow after and step away from the day job. So I want to get a little bit more out than that. So I've been evaluating the high LTV HELOCs and whatnot. And I don't know if anyone has experience with those, but apparently with those, you can go up to 10, 5%, or 90 or 95% LTV. Yeah, so that's kind of the scenario there. I don't know what you guys would recommend to do next.
Are you saying like get a HELOC on the property? Do you recommend, you asking us if we recommend it?
Yeah, or the high LTV HELOCs. If it's I don't know really how those programs work. I think it's just going to be like a higher interest rate, right? And I can tap into a lot more of the equity.
Generally, it's a fixed rate plus prime. Prime moves, so the whole thing isn't fixed, but that portion they call the margin is fixed, and then they add it to prime. Prime's currently 3.5. Used to be 3.25. So, and then those combined rates is whatever your rate is on that HELOC, and it's usually interest only for the first 10 years, and then it requires you to pay principal in the following years. But most people, they constantly renew their HELOC, or they get a bigger one and they refi it after like 2-3 years lately, because value's been skyrocketing. So the thought of having it for 10 years, it might be a possibility, but it's not always the case for most people. Whether you should get it or not, it's up to you. I mean, right? Do you want it for asset protection to make it look like you're fully leveraged so nobody sues you? Or do you need it to do subsequent investing? Those are all questions you ask yourself, I would say.
Okay. Yeah, no, I definitely would. I'm leaning towards doing the HELOC more. Just I can pull more money out and I can do other things with it. Just from I guess I was just thinking from getting the loan or the refinancing versus getting HELOC. I feel like, well, I don't know. Do you know if documentation or difficulty wise, it would be harder to do one versus the other? And also maybe keep in mind, my credit score dropped a lot, so I think I'm going to repay some of it so it goes back up and then do it. I don't know how much my credit score dropping a bit would impact both of those loans or the rates for those loans. I don't know if it's significant or not to care about.
Well, you will want an interest only, so that when you do apply for new loans in the future, the payment on that HELOC won't kill you. Because if that payment's principal and interest, it might max you out, right? Let's say your house, your first mortgage, your second mortgage. Let's say you have other liabilities. That all those added together might be too much for the income, or maybe you have a really good income and you still have room. You definitely want your situation looked at, like not only looked at today, but looked at hypothetically in the future. If you were to buy something, how would your income be looked at? So it's like a future pre-approval, like a hypothetical. So you would want to know both scenarios. That way you can plan. Because if you don't know what you're doing, you're just kind of guessing. Or most lenders, they give you a pre-approval today for a specific price. That only lets you know you can qualify for house A on today, with today's rates. It doesn't give you any planning perspective on what you can do in the future or how things will change. Because everyone gets bonuses, raises, overtime. People's incomes and lives change. They pay off their car, they get a new car. So things change. You definitely want it looked at, I'd say.
No, that's helpful.
Yeah. Hey, Julie, this is becoming like a mortgage planning webinar.
I think Julie mentioned she might have to step away.
Oh, did she?
A little
I didn't know.
Yeah.
Somebody's getting called. That's cool. Yeah, I mean, we kind of answer a lot of these mortgage questions because a lot of it relates to the real estate side and how you guys are gonna plan to buy your next properties. So If it's helpful, we can answer some of those questions.
Sorry, Albert, I was getting a FaceTime. That was me.
Oh, yeah.
What did you mention about a call?
No, I'd be happy to answer some questions for Julie and Joe while she gets back online. Have you already done your pre-approval and got an idea of what you could do?
Well, I mean, the main thing right now is to kind of finish my second project, and I need a little bit more money for that. So that's where that's coming from. To finish the second project, I'm doing like a two-phase thing. So I'm only getting it 5 rooms, and then I need a little bit more to get it to 8 rooms. And then the first house I have an ADU that's approved, and I'm just trying to find a way to finance. Kind of planning to get that ADU done on the first property before I do a refinance. That way I can, that appraises for a little higher. I don't know how much it will reflect, because I know ADU appraiser, the appraisals are not as accurate, but I think it should do at least something, right?
Yeah, I've seen people include it in the whole gross living area. So if your house is 2 and your ADU is 1,000, lately I've seen them included as 3 living space, but not 2 units, just a larger house. So then you got to look at larger comps in your area, like a house that's 3,000 square foot, and try to get them to use that. It doesn't necessarily mean it's better though, but at least you'll get something for your ADU, right?
Right. Yeah, I think that's a good point.
Because typically when houses get bigger than 2,000, the dollars per square foot get less and less. You'll notice that when you hit 3,000, it's even less per square foot, and then 4,000. There's like a marginal return on the value of your home as it gets bigger and bigger.
That's a good
It
point.
seems to be the highest around 1,000 to 2,000 or 2,500 square foot. It seems to be the highest, like in terms of selling price divided by the total square feet, and you get dollars per square foot. That's the range I see the highest value in trying to rehab and enforce value or create value.
Yeah, I'll ask around to see how that's being done around here. But no,
Yeah.
I agree. It might be worth, instead of the 80-90K being put into the ADU and then doing the refinance, maybe doing the refinance before, since it might not increase the property value that much.
Yeah, if you need the money to do the ADU, then you have to do the HELOC before, right? If you can build the HELOC just with cash, then you might want to wait till you have the full value. So it depends. Because I think I'm hearing that in Seattle, it costs around $250 a square foot to build. I don't know. I've never built an ADU.
Wow. Yeah, that might be a separate, I think, from the ground up.
Yeah. So something you want to look at, unless if you have the cash, you could always finance it with cash while you're waiting to get all your lines and loans in place.
Yeah, I mean, what I got stuck with was I used the kind of 0% APR credit cards to finance some repairs for the second house, and then now my credit credit score went down, and I'm a little concerned that's going to affect it, because I thought, okay, I'll just refinance and pay them out through the refinance, but now I have to pay some of that down before refinancing, so the credit goes back up.
You're talking about revolving lines, right?
No, these are just normal credit cards.
Yeah. Well, on revolving lines and credit cards, those are considered personal lines. So if you max them out, it's going to probably tank your score about 90 to 100 points temporarily. Once you pay it off. Yeah. It'll go back though. It just takes about a month.
Gotcha.
So
yeah. Maybe I'll try to get this under 30% before doing the HELOC or refinance, just to get a bit better rate. Yeah.
I mean, if the card's maxed out and your score's lower and you apply for the HELOC, it might affect your HELOC pricing too. But that's, if you need the HELOC to pay off the card, then it's like the chicken or the egg. You're gonna have to do it to pay off the card, unless you have the cash or can get a gift.
I think it's funny. I'm just I'm trying to be creative to pull money from different places, just to get to fill in the gap, basically.
Yeah, I mean, there's a lot of places you can do 401ks. You can take out a title loan against your car if you have equity in your car. based on Kelly Blue Book or whatever value. There's a lot of places you can pull.
Yeah, I'm looking at the 401k right now.
Yeah, that one's one of the better ones for sure.
Yeah, I think that's what I'm looking into, Justin. Makes sense. Albert, what are you working on outside of, I guess, lending? Do you have any personal investments you're working on?
Mainly just rehabbing units and increasing rents. So nothing too crazy. No purchase scenarios. I'm kind of waiting the market out right now. Trying to see how to adjust with the new rates. So there's a lot of rehab projects to do, and there's very limited amount of labor. So that's my hurdle right now. Just trying to wait for that to improve, to get more contractors.
Yeah, I noticed that too in California. Just doing this project over the last couple of months.
Oh, I forgot you're in California, right?
Yeah, I'm SoCal. Yeah, just even getting materials was hard. Getting like the right doors. I had like a couple big doors here, and a lot of small little things like that shouldn't take long to supply chain, and also the labor thing. I ordered some digital locks, and when I closed on the house, which was mid-November, and they just got here last week.
Wow. That's like Amazon Prime. It still took that long?
No, that was like Bill.com or something. They're just, those are like very popular ones, and with everyone doing Airbnbs, like those are the best locks out right now. And it just took really. I ended up buying some for overpriced on eBay, so now I'm just getting rid of these for a little extra because I don't need them anymore.
Mm-hmm. Yeah, it definitely is hard, especially doors. It seems the doors are definitely tough to get to. So I've moved to more generic doors just so I don't have that issue, and then we'll switch back to the fancier looking doors when things become more supplied better.
See.
Yeah, right now I'm doing a lot of paint jobs, so mainly exteriors, keeping everything revamped and trying to keep rents going up to market, which is kind of hard because market's going faster than some of the legal city restrictions are allowing us to do.
That's challenging.
Yeah, SoCal I don't think has any income caps, right? Unless if you're in LA.
I think I think a couple counties do. I mean, LA doesn't. I think they were talking about something for Long Beach. Or I'm not sure.
Oh, like city specific?
Yeah.
That makes sense. There's a lot of affordable housing folks in Long Beach, so that probably is going to be something they're going to bring up for sure.
Yeah, they just North Long Beach. They just, well, not just. I guess last year they approved the big zoning change for a bunch of industrial things, and now you have a bunch of construction and a lot of restaurants and businesses coming into like this big strip. I don't remember the streets, but that's going to really push everything else. So I guess they do need that protection.
Yeah, that's pretty cool. I forgot everyone was in different states. So how did you get onto the Seattle Investors podcast?
Actually, I was looking at one of their podcast, their YouTube videos, and I think it was your episode on lending. I was just this was after the first house. I was trying to understand how to structure things and how to plan things so I could continue to qualify for houses. And then I just started YouTubing that, and I found a couple of videos, and I found this one, and then that's how I ended up on it, which is kind of crazy.
Oh, nice. So it was completely online. Wow. And Joe might have to take note of that. So we're pulling people from different states. I thought it was just a Seattle podcast. I didn't know.
The name is actually The Nuts and Bolts of Real Estate on YouTube. So that's we've generalized quite a bit ever since COVID hit and we're not in person. So most of our people do come in from online these days.
Wow.
Albert, where are you keeping like your cash while you're kind of waiting to see what the market does?
I usually pay down lines.
Oh, okay.
So I get all these commercial lines that and I make sure they're types of lines that calculate interest daily. mean, it's better than parking it in your checking account, right? Because that you earn nothing in your checking. So that's where I put it. But you're still losing money because inflation is way higher than the interest saving. Even on the line's like 4 to 5%. So, I mean, it's better than earning zero, I guess, while you're waiting.
What do you mean commercial lines? Like what exactly is
It's
that?
kind of like a HELOC, but imagine it with commercial terms with the local community or credit union. But they're more creative. They can blanket, multiple properties. So instead of getting like 100K HELOC on every rental that, you have 9 HELOCs to micromanage, it's a pain in the butt. You could combine like 9 properties together and get like a $3 million line, for instance, as an example. And then you could just pay one mortgage per month. Is it risky? Could be if you don't know the terms of it. But from a use point of view and deployment, it's much easier because there's only one bank to issue wire instructions to send your money out versus, a draw from 9 lines, like 10 grand from 9 lines, and then combining it in your checking and then doing a wire instruction to close on a property. So I'm about like efficiency because I don't want like try to minimize my brain damage, as I always call it.
Gotcha. So you're not really keeping a lot of cash. You'll just have these lines. And when you decide you're going to buy a property, you'll just draw from the lines.
Yeah. Because I don't want to keep that cash in places that I can't get access to. So I definitely don't put it in IRAs or anything like that. Although the CPAs want you to. I do keep reserves for living expenses, but beyond that, I'll put everything in the lines or like the permanent life policies. I guess they call them infinite banking or whatever nowadays. But because I could access those within 5 business days, like a perm life policy, permanent life. The lines are pretty much instant. You send in the wire instructions, you can get the money out today before 2 p.m. Pacific. So yeah, as long as I can get access to it in less than a week, I consider it liquid.
Gotcha. And so when you've drawn on those lines, so do you have properties that you've bought that you don't really have like a bank loan for? You're just completely bought them out of those lines?
Yeah, I do that too. But you want to have a good mix though. You don't want to have all lines because it's too risky. You want to have like some fixed, some lines. For some people, they can do like like 50-50. They'll be able to sleep at night. Everyone has their amount of risk they can take before they can't sleep anymore, I think. So for me, I can do 50-50 and be fine. I think some people, they need like most of the loans to be 30-year fixed and then like a couple lines. Does that help?
Yeah, I think so. I'm just like, kind of in that situation right now. I just did a large cash out refinance, but we're kind of waiting to see, what happens with the market. And it's also hard to find, multifamily properties right now. So we're kind of sitting on like a couple $100,000. That's like just in a checking account right now. I'm just trying to figure out what to do with that.
It's just scary if the money goes down faster in value and the properties go up faster.
Right.
Like pretty soon your money that was 25% of the price is now 20% of the price, is now 15% of the price. And then you can't even buy it all. And it's like, oh. So that's the concern I have, at least. I'm trying to keep it growing as much as I can without too much hassle while I find a potential deal. But right now, a lot of the rehab investments are looking better than buying new because I could spend 35 grand and get $500 to $700 more in rent in Seattle with a full rehab and all the tax benefits, the value increase beyond the cash flow increase, beyond the rental per month increase. It just, when you do those numbers and you compare it towards buying new, I have to look at both. It just seems to be better just to keep rehabbing for now for me, but everyone has a different situation.
Gotcha. Yeah. So do you see like commercial multifamily getting impacted by the rates as well, since multifamily rates aren't quite as high for like the shorter loan terms. Have you seen any like indication of an adjustment there yet?
Yeah. Like I think Julie mentioned earlier, they were up to 4 for that one really good one, but most lenders are in the mid 4s to high 4s. The credit unions are probably in the low 5s.
Okay.
And they were like in the 3s and 4s, lower 3s and low 4s in maybe October, December. So
I think what people are doing is they're using the shorter term products as gap solutions with their, keeping the rates low and just really being a little more planning things out in order to keep doing business during this environment. They're mixing their products to make it work, I guess I'd say. You think, Albert?
Yeah. I mean, and because I have to compare when I look at like from a finance perspective, if I spend $1 and my return is, a dime a year or 10%, like where can I put that dollar to do the same amount of work with the least amount of headache is how I look at it. I'm not trying to do like short-term rentals, or some people might, but I just don't want to. Or if I put it back into the mortgage company and hire some people, can I make more return? So that's how I look at it too. So it's three different ways. Right? Do I rehab existing units? Do I buy new units? Do I put it somewhere else? And if there's nowhere else,
what type of return do you think is good? What type of return? I'm always curious to know, because it's such a personal decision, what type of return that people are looking for, because it always surprises me they'll accept a lot lower than I would have thought, right? I mean, I grew up doing multifamily, big renovation projects on big, commercial sized properties where, we're looking for a minimum, like 15%, cash on cash and a minimum, appreciation upside, on these big projects. And, I know like Dion isn't here today, but his threshold is 10% and he doesn't do renovations, right? I believe I'm speaking for him, so that's not fair, but I believe he's interested in 10% that he can maybe achieve that in the, at the end of the first year or something by raising rents, right? But you get all these other investors, like I'm working with a buyer right now. That's why I had to pop off for a minute, who's wanting to make an offer on this 5 unit we've got here in Seattle. And she's throwing out these numbers and I'm like, I don't, not really, it already didn't pencil from the beginning. So are you sure you want to offer that, that escalation? I go, what are your goals here, as far as this investment goes? And, some people are willing to take really low returns because they just are going to hold on to it for a long time. Right.
Yeah.
And it's hard to speak in terms of, oh, well, this is a good deal, this isn't a good deal, because everybody's threshold of what's a good deal is different. Their motivations for buying properties are different, right? Then she says, well, I want to BRRRR this apartment building. And I said, well, you're not able to do that with all these loan products that we've talked about. They all have prepayment penalties, and so it's just,
she's going to have to take a higher rate with no prepayment. It's probably like 0.25% more in rate to get the prepayment down to 1 year.
That's worth it though.
Yeah, because you don't want to pay 5 points, because what did you say? It was 5, 4, 3, 2, 1. That's a lot.
Yeah.
5 points the first year.
No, it's totally worth it to pay the higher rate to get the freedom if you think you can achieve your higher NOI, your higher, situation there. But
right, there's a lot of people who don't know that, and they didn't know they could reduce the prepay, so they end up just doing the loan as is, and they end up with the prepayment penalty after year 1 or year 2. And,
right. How could they not know that though? I just don't
understand. The saying is that if you thought professional help was expensive, wait till you see unprofessional help.
Right.
Is that the same, or there's a meaner way of saying it?
Yeah, I got you. Right. Right. I just said, well, none of these numbers you're talking about totally make sense to me, but I'm here to just make sure to keep the guardrails on so you don't hurt yourself, so
Yeah.
you tell me what you want to do, and I'll tell you if I think you're hurting yourself, or is really how I'm rolling on this situation. But yeah, good stuff, guys.
Well, because if rates keep going up and then the cap rates stall out, so she's not getting any more appreciation purely from the market, cap rate going down, which causes value to go up.
It's interesting because I said the lender is using a 5 cap on market rents. Okay. And I was using a little bit lower. So maybe we need to redo it at 5 cap. And she said, well, if there's competition, we can pay this. I said, well, if you pay that, you're paying for the upside of even the whole point of it, getting the market rents. You're overpaying, and
Wow.
so I don't, just trying to,
Yeah, I really think people should get familiar with cap rates and how they work first before they venture out of the 1 to 4. Because
and and the reality is that as is existing cap rates that people are willing to pay on actual numbers are low, 3.5%, something like that, 3.75, whatever, in the 3s. That's just off the existing rents. Nobody's really looking at that except the lenders, right? The buyers are looking at what the value add component is, and they're placing a range of cap rate potential on a stabilized number is going to be higher, right?
Yeah.
You might have to buy it on a 3.75% cap rate, but when you go to refinance or sell it once it's stabilized, the cap rate's going to be higher, which means that you don't take the cap rate that people need to understand that, right? And
you're paying for your future equity, but you're paying for it today.
Right, but there needs to be enough spread between there's going to be a spread between your existing cap rate and your stabilized cap rate, right? And that spread, needs to be high enough. So anyway.
Yeah, I think that sounds like her scenario. She's going to have to figure out what that future equity is and how much of it is she okay with paying today versus how much is she willing to work for? Because her numbers might be too rosy or in the sky, and she might not even be able to reach it.
Well, what I said is, if you pay what you just told me, your maximum is you're willing to pay, you're paying for almost essentially all of or too close to what your, stabilized market value is. Once you do all the work to get the units up, to market rents, you're giving away your upside if you offer that. And then the only value is just hanging onto the building and hoping rents appreciate, because remember, in multifamily, it's not like a sales comparison approach. It doesn't appreciate that way, right? The only way it appreciates is if rents go up or your net NOI goes up, or cap rates come down, what people are willing to accept. Well, they're already so low. I don't think they're going to get much lower. So if you guys ever need help with this, give me a call. But it's a lot of moving parts, right? It's kind of like you pull one lever and the other pot changes, right? You gotta pull about 3 different levers to see where the numbers end up. Anyways,
yeah, definitely.
Well, that's all good, guys. Yeah, but anyways, regardless, if anybody is looking for a commercial loan, if you're looking for 4 units or less, or any of your single family or any, obviously you guys know Albert's your dude, but he doesn't do commercial. So if you, I would definitely recommend this Crux Commercial Real Estate guys out of Tacoma for commercial. Give them a shot at pricing out some commercial financing for you if you need that. Obviously, it very much depends on your strength and your experience when it comes to that. But all doable, flexibility. This buyer that I'm working with has never owned a 5 units and above. I think she has a 4-plex. And so that qualifies. They're fine with that. I think she has some single family rentals and a 4-plex and they're cool with that. So you don't have to, anyway. You guys ready to wrap it up today?
Thanks for sharing that commercial lending resource. I'll definitely reach out to them in the future.
Absolutely. Yeah. Right on. Okay, guys. Good talk. Thanks, Albert, for being there, our crutch today. And Joe, thanks for keeping the lights on for us, Joe.
Thanks, Julie.
All right. See you guys.